Welcome to our morning session and on a very, if I can use this word, enlightening topic. See, PGBP is a very important topic when it comes to exam. Equally important is capital gain, but more than that, it is more of an enlightening topic. Why do I say enlightening? For the reason that whenever in practice you are handling income tax, you will find that even though every year the maximum quantum of work that you will be handling relating to income tax return filing would be PGBP related. This may not be in terms of quantum of work, but whenever the litigation point comes, whenever the disputes comes, you will find that a major share in disputes would be of this topic. Plus, even though quantum wise the topic may not be used for every assessee every year, but in whichever year the assessee has a transaction which gets covered, which gets triggered under this head, the amount of tax exposure is very huge at times. The reason is very obvious. When you are selling a capital asset, if the value is running in multiple crores, there is a good possibility that the capital gain, that is a final taxable amount, will also run into multiple crores. And this is where this topic gains lot of relevance again in practice, though it may not be there for every assessee in every year, but in whichever year your client assessee has a capital gain transaction, that becomes the most significant year for that assessee. So with this backdrop, let us start today's session. So very good morning, everyone. Yes, good morning, Anshul, Vishakha, Isha, and everyone present over here. So let us start. We start with a brief revision of whatever we studied in the previous class. So when we are talking about this topic, this head of capital gain, few things you need to know and remember. One, not every capital receipt is a capital gain. Very important. Whenever as a student you are thinking about the income tax law, you register this in your minds that there are 5 categories, 5 heads or 5 sources of income. And in that, this head covers only capital income. To this extent, your understanding is correct. But the next point, that every capital income will be covered under this head, is not correct. So you need to keep in mind that this head will cover only capital incomes. No revenue will be covered. That is correct. But each and every capital income will be covered under this head is not correct. Then comes the second point. Then what all capital incomes are covered? So the answer is here. You have to satisfy 2 tests. One, do you have an asset, which is a capital asset? And have you transferred that asset? Any one item missing, there will be no capital gains. And then the third point is, since this head is a capital head and capital is an exceptional item, normally we always talk about revenue incomes. So this is an exceptional head. And the beauty of this head is whatever you study, every point, every provision that you will study will have some or the other exception. And that is what adds beauty to this topic. That you study something, but you should know that that will follow with something which is not matching with that provision. Why? Because the law itself has created certain exceptions. Now, the most important part, solving sums. The interesting part of this topic is that this is one of the most smallest topic when it comes to solving. It can take hardly 1 minute in the exams to put down these figures. And the best part is you have to only select the figures from the data given in your question. There is hardly any working note required for that. But even though solving or writing down the answer requires 1 minute, but the bigger challenge is first reading the data, assessing what figures are relevant. That will require in-depth knowledge of the provisions which are multifold. This is one of the longest heads in terms of number of provisions, because as I just mentioned, whatever you study, there would be multiple options, exceptions. So that itself creates multiplicity of provisions. And at times, since there are exceptions, in some cases, exception to exception, so many times students get confused. But let me tell you, rather assure you, that how you got comfort with PGBP, which generally, if you speak to your seniors, they will say, no, no, it is very difficult, it is very vast. But now you have a comfort. Now you only need to convert that comfort to your strength. The same thing I assure you, you follow the logical sequence which I am explaining using in my class, follow it, and same principle like PGBP, kindly revise this. Acha, I'm assuming that you are also parallelly revising the previous chapters. See, taxation law is a very vast, very intricately connected provisions law. So it is very important that whatever you have studied in past, you take out time every week so that it should not get evaporated and it should not become blank again. And I'm sure you're doing this for all chapters which are concluded till date. And please follow this for capital gain. Every lecture, whatever I'm teaching, you should come studied at your part from the module. And you can always ask questions on whatever you could not understand. Now coming to the format part. Now when it comes to format, in the format, the first thing that you require is the sale value. See, we need to find out profit or loss on sale of asset in very simple words. So for that, the first value will be the sale value, which is technically referred to as full value of consideration, in short FVC. Then the second value will be the amount that you have spent as expenses in order that you could sell this asset. Now this will include advertisement. If you have hired an agent and through that agent you got this work, so commission, legal fees, registration fees. So these are those expenses which were incurred, rather they were necessary to be incurred so that you could sell, that is transfer the asset, hence it is called as expenses on transfer. Subtracting these two gives you a figure called as net consideration. And then from that, in simple logical sense, what you are deducting is the cost of your asset. Now, in the eyes of law, cost is made up of two parts. First, the initial cost, that is when the first time you purchased, constructed, created the asset, which is called as cost of acquiring, that is acquisition. And second, in some future year, you did some capital expenditure, some capital additions to the asset, which increase the life, the value of the asset. That is what is over here called as cost of improvement. And then subtraction of these two items will give you your final answer, which is the capital gain, or if it is a negative figure, it is a capital loss. Now, earlier, prior to this chapter, you would have heard these terms, long term, short term. So we also are going to study what are the different types of capital assets, that is which asset is long term, which one is short term. So that will decide whether the final resulting gain or loss should be called as long term capital gain or short term capital gain. And from this figure, you have to deduct something so that you get your final taxable capital gain. Now, our role is to study this entire format into different parts. So we start with the first thing, that for this chapter to be triggered, this topic to be attracted, you require two things. There should be a capital asset and the asset should have been transferred. Now, we studied the entire transfer concept in the previous class. Let me summarize. Section 240 7, that is 2 bracket 47 or 2 clause 47, which defines transfer, says transfer includes. Now, what are the different transactions which it had mentioned will be included in transfer? So selling your asset, exchanging it with something else, or relinquishing your asset. What is relinquishment? Relinquishment means giving away, discarding, something like donating, something like just giving away as gift, or just discarding. So sale, exchange, relinquishment, right? Then extinguishment of rights. Now see students, I am revising from what we studied in the previous class. Now when we talk about extinguishment of rights, here what you are extinguishing means putting an end to, is not the asset. The asset remains. You are putting an end to the rights in the asset. So this, for this, if you remember, I had given you the example of joint property, that whenever there is a joint property and you want to move out of that property, so what you say, whatever is my part ownership, part share, part rights, I am putting an end to that right. Obviously, through an agreement, through a contract, that is what is extinguishment. Then comes some special transactions. Converting a capital asset to stock in trade. Now, in this, again, if you remember, you actually do not sell the asset today. What you are simply doing it, the asset which you are having, that asset is simply the status is changed. So what you are showing as a capital asset, now you are going to show it in your balance sheet as a stock in trade. This was resorted to by many to evade tax. I had given an example of this in the previous class and get understood this in detail. Then comes the next category, that is compulsory acquisition. Now, what is this compulsory acquisition? So compulsory acquisition is where the property belongs to you. You are the legal owner. You are the true owner of that property. But because the government has some project to be constructed, so they compulsorily take away your property. They do not give you an option whether you want to give it or not. They have the rights under the Land Acquisition Act to compulsorily take up your property. This is what is called as compulsory acquisition under law. Now, obviously, it is not done free because it is your legal property. So you are paid for it. That is what is compulsory acquisition. I had to give an example of bullet train. Then comes the next thing, that is maturity or redemption of zero coupon bond. So whenever the life of the bond is over and you return back the bond, what you get in exchange will be part of capital gains. Then again, there is a special transaction whereby what you are doing, I'll just try to explain you with the previous example so that it is clear. So what you are doing is you are having a shop, you have booked a shop which is on the ground floor. Now the building is not yet complete, but you want to start that shop because there is some auspicious date coming. So on that date, you need to do the opening. So you pay the payment and you are given the physical possession of the shop by whoever is the owner of the shop. Now, in this case, legally, the shop cannot be registered in your name because the building is still under construction. However, as per Transfer of Properties Act, Section 53A, which was introduced later as an amendment, the Transfer of Property Act consider this act of giving an under construction shop also as a transfer. So the same thing is replicated in the income tax law. They say that even giving away an immobile property which is still under construction. Now, what is this part performance? It is the physical handover. So physically, you are given the immobile property, though legal documents are yet to be signed, they are yet to be made, but physically the property is handed over to you. So that is what is part performance of contract. And then the last is any other transaction which has the effect of transferring the immovable property. Now in this, I gave you example of your house, which is under a housing society. You are having one flat which you have purchased, but technically, legally, the flat is not in your name. Rather, what you purchase or what is in your name is one share in that society. So let us say there are 200 flats, so there will be 200 shares, one share representing one flat. Now, what you do on paper is you show that you have purchased a share. And then the society says, okay, now you are my shareholder. I am giving you one flat to stay. Now, in future, whenever you want to sell this flat, again on paper, what happens is you show that you have sold the share. But in effect, what is getting transferred or sold is the flat. So this last clause says such transactions which on face appears to be something else, but in effect they are leading to transfer of immovable property will also be treated as transfer of immovable property only. So this transaction will not be taxed as a transaction of sale of shares. It will be taxed as a transaction of sale of immovable property. So these are some specific situations which are treated as transfer. Now let me take up queries, if any. So if any of you have doubts, queries, you can put it across. Yes, students, anybody, any queries? Now, as I said, the beauty of this subject, this chapter is that whatever provisions you will study, each provision will come with an exception. So there is not a single provision in this chapter which will not have any exception. So whatever you study, immediately some exception will be thrown. Now, when we have studied that, okay, all these transactions are transfer, so there is exception to this where few transactions are regarded as not a transfer. What it means that in case of those transactions, even though it may be a sale, even though it may be an extinguishment, even though it may be one of these transactions, but I do not want to tax it. And how I don't tax it? By considering that whole set of transactions as not to be treated as transfer. The moment you say that it is not to be treated as transfer, you are outside the capital gain chapter. Okay, somebody has asked me, sir, extinguishment of asset means. Anshul, beta, I don't know whether you're present or not. I'd explained it here. So firstly, it is not extinguishment of asset. I clarified that asset remains. It is the extinguishment of the rights, whereby I had given this previous example in the previous class that there is a joint property. So there is a flat which is in the name of two brothers. Now, there are regular disputes between them. Now, you cannot split the flat physically. Had you been able to split the flat, you could have sold your independent part of the flat, which could have been then sale. But that is not possible. So what you say to your brother is that, okay, instead of having dispute, let me do one thing. Whatever is my part ownership, because we are joint owners, so there is some part ownership I am having. Let me give away the rights of that part ownership to you. So what you do is you extinguish. Extinguish means to put an end. See, try to take the dictionary meanings. It will make it more easy to understand. So you put an end to your right in that particular property. How do you do it? By making an agreement. So that agreement is also a transfer transaction where even though you have not sold the entire flat, but whatever part ownership rights you had given away that rights. That is, you have put an end to that right. That is what is extinguishment. So Enam beta, at the time of conversion of capital asset into stock in trade, you are not getting any sale consideration because there is no outside person, right? That is where you will find that as we proceed with our format, the very first thing we have to decide is what is the sale value. So the law has given you an artificial value because the law is treating this transaction also as transfer, which is converting a capital asset into stock in trade. The date you are converting, there is no outside party, it is you only. The building, which you normally call as fixed asset, now you are calling it as stock in trade, but you have not given it to anybody outside. So in that particular case, for the purpose of taxation, the value will be determined on a deeming basis that we will study what the law has given. I'll explain you when we come to that particular point. Fine. Now, what are the situations which are not regarded as transfer? So first one is in section 46(1), remaining all are in section 47. Now, the first one is where a company is under liquidation and it gives away its assets to its shareholders. So the company needs to pay back to the shareholders. Instead of giving them money, the company says, okay, these are the assets which are left. You all take up the assets so that I am able to get relieved of your liability. So when a company gives away the asset to shareholders at the time of liquidation, that is regarded as not a transfer, so no capital gain will arise. On similar lines, the second transaction is when HUF is under partition, either complete or partial, whatever it gives away to its members. At the time of partition, obviously what HUF will also do, it will say, okay, these are my properties, you all divide it. So HUF gives away its properties to its members who are the co-partners. That again is a type of relinquishing the property, but we do not want to tax it, so it is not regarded as transfer. Then the next one is wherever an individual or HUF again gives away the property. How? By way of gift, will, or donation to a trust. Such giving away of property is also to be regarded as transfer. Then next two clauses, 4 and 5. In this case, what is happening? Either a holding company is giving up assets to subsidiary or a subsidiary is giving assets to holding. And here the condition is it is 100% holding. In this case, where 100% holding is selling any asset to subsidiary, or that 100% subsidiary is selling asset to holding. Since in both cases it is 100% holding, so I am the owner of that subsidiary. So whether I earn from subsidiary or the subsidiary earns from me, it will make no difference because in both sides it is me only who is the owner. So it is like I'm keeping the money from one pocket to another. Hence the law says we will not tax it. The only condition that the law has put is that the recipient should be Indian company and it should be 100% holding subsidiary relationship. Then again in next clauses of 6 and 7, you have the scenario of holding company, sorry, not holding, amalgamating company and demerging company. So what happens in amalgamation and demerger? The old company gives away all its assets and liabilities to the new company. Now here in income tax, there is a requirement that minimum 90% shareholders of the old company should also be shareholders in the new company. Now, if more than 90% are same, it means as good as the owners in both the companies are same. So on similar logic, what we discussed for holding subsidiary, on same logic, in case of amalgamation or demerger of companies, They are saying that whatever assets old company selling to the new company at the time of amalgamation demerger, we don't want to tax it. Then comes the next scenario, which is part of this category only. What is that? Now, whenever any amalgamation demerger happens, what happens in the hands of the shareholder of old company? Now, we all know old company is closing down. It is getting merged with the new company. So what does the shareholder do? Whatever shares the shareholder has in the old company, it gives away those shares, and in return, it gets the shares in the new company. Now, this is a type of exchange, but the law does not want to tax it. So they have kept this transaction also in no transfer category. Then comes another scenario of section 47, where non-resident is selling to another non-resident, and what it is selling? It is selling government securities, and this transaction takes place outside India. We want to promote foreign investments in India, so we are giving them this relief that if you have purchased a government security, you are a non-resident, and in future you transfer this government security to another non-resident outside India, we will not tax this transaction because we will not consider it as transfer. Then comes furthermore transactions where you had preference shares or debentures, you gave up them, and in exchange you got equity shares. Now this is a common adjustments which you find in accounts, where you had originally purchased preference shares which were called as convertible preference shares, or you had purchased convertible debentures, and now after 5 years or whatever time is fixed by the company, you give back these old assets, which is preferential debentures, and you get the new asset, which is equity shares, right? So students, these are few transactions which are not regarded as transfer. Now in this, there are two very interesting more transactions which are not regarded as transfer. Those two transactions are that if you are having anything which is considered as of national importance. Now, what could be this national importance item? It could be a book, it could be a manuscript, it could be a photo, painting, anything which the government considers it to be of national importance. So they say, don't sell it outside India. You sell it to government, national laboratory, museum, any such things. So whenever any of these assets is sold to government, to national museum, or any such places specified by the government, instead of selling outside, this sale will not be regarded as transfer because we do not want to tax it, so that the thing does not goes out of India, right? And then there is one point which is slightly different. So I kept it for today. I did not cover it in the previous class. So all these things we have discussed till now, right? Yes, one more point this is left. Redemption of sovereign gold bonds or conversion of gold into electronic receipts. So redemption of sovereign gold bonds. So government does not want you to purchase physical gold. So it is saying you purchase my bonds. Whenever the maturity will come and I will redeem it. Redeeming is a transfer, but this redemption will be not taxed because it is kept outside transfer. Similarly, again for promoting that you do not purchase physical gold, but if you have physical gold, you can give this gold, and in exchange, I'll give you the electronic gold receipt. So you can keep the gold in electronic form, and in future also you can purchase, sell this only, or vice versa. If you have this electronic receipt, that is the gold in the electronic form, and now you want physical gold, you return it to us, we will give you back the gold. So both these transactions of giving gold and taking electronic gold receipt, or giving gold, electronic gold receipt and taking gold, which is actually an exchange, is not regarded as transfer, right? Now, coming to an interesting case. Last situation of not transfer, which is reverse mortgage. Now, what is this reverse mortgage? So, government identified that unfortunately nowadays they are observing it, they are seeing it, they are getting those complaints in the police stations that when parents get senior, that is, they cross the age of 60, and that also indirectly means that now they are not actively working, maybe they are retired. So now they are dependent on you for their caretaking. Now they have some property which they may have created out of their efforts, their entire hard work for their entire lifetime. Now, as you grow up, as you start settling, out of love and affection, many times the parents, they give away their property to you. Now, the moment they give away their property to you, which is obviously given free because that is given as a gift or will, now the government found they have registered such cases, and which were also going to the courts there, that the children are throwing out their own parents from that property. Very painful point, that the property belonged to parents. The parents had earned that property, or maybe that is their inherited property. Now, out of love and affection, they have transferred it in the name of their children. And after that, the children are themselves keeping them outside their own property. Now, in such a case, to protect such parents and also to make them independent, the government came up with a beautiful scheme. Beautiful scheme. What is the scheme? The scheme says that parents should not give the property. Now, what is this property? Their house. The parents should not give this property to the children. Rather, they should sell this property to a nationalized bank, and it is sold under a special scheme which is made by the government. Now, this scheme is called as the reverse mortgage scheme. Now, I'll understand why it is called as a reverse mortgage. Now, when parents are selling the property to the bank, let us say the property's value today is 2 crores. The bank will not pay them 2 crores. Bank is as good as taking a loan from the parents of 2 crore. Now you are saying, sir, where the bank has taken a loan? See, bank has purchased a property, so the bank has to pay 2 crores to the parents, which it is not paying. It is showing it as a loan from your parents because it has to still pay back those 2 crores to your parents. So whatever 2 crores, that is the consideration for the property, the bank is not paying immediately. That is now standing with the bank as a loan given by the parents to the bank. Interesting. Now, if somebody has given loan, that person will ask for a security. So the parents are asking for a security. They are demanding the security from a bank. Now I have given you loan. Give me some security assurance that you will pay back the loan. So the bank says, okay, do one thing. Keep this property with you as a security. So the best part is parents have sold the property to the bank, but they are occupying the property. So it means I'm still staying in my property. And even though I've sold it to the bank, still I am physically staying, occupying the property. Best. So I still have the control over my property. So now I'm not on the road. I'm still staying in my property. And this property is already sold to the bank. Now you'll say, sir, what is the benefit of all this? The benefit is that this 2 crores, which is now become a loan given by your parents to the bank has to repay back the loan in installments. So now the bank will be every month paying to your parents some amount out of this 2 crores. Like how you pay EMI to the bank, your bank is going to pay EMI to the parent because the parent has given them or sold them a property of 2 crores. Now the bank has to repay back this 2 crores over a period of time, whatever is decided, 10 years, 15 years. The rule is the bank will pay until both the parents survive. So husband, wife, until both the parents are existing, are alive, the bank will be paying EMI. Now, firstly, let me clarify why the name is reverse mortgage. Because here, the bank has given asset to your parents as a mortgage. Normally, we take loan from the bank and we give bank some property of ours as an security. Here, the bank has taken loan of 2 crores from your parents, and to secure their loan, the bank has given them this house property as a mortgage. So the term given to this scheme is reverse mortgage because your bank is giving mortgage. The best part is now for parents, there is a monthly regular earning coming. And this will come until both the parents are alive. So even if one is dead, other one is alive, the bank will continue paying this. Now, the even better part of this is that whenever both the parents, whenever they will pass away, the bank will not keep the property. The bank will give option to the legal heirs, that is the children, that okay, boss, see, this is the property of your parents. Under this special scheme of the government, they had sold the property to us, but we do not have any intention of keeping the property. We are offering this property to you. If you want, you can take back the property from us. But obviously, since we have paid some amount to your parents, you just have to pay back that amount to us. So if you pay back that amount to us, we will give back the property to you. So the best part is now, if you want to keep your ancestral property, so we are not taking away your ancestral property. Most importantly, the EMI, whatever the bank may have paid to your parents, may not be even equal to 2 crore because let us say they passed away early. So they are offering you the property not in the current market price, only to that extent to whatever they paid to your parents. I hope you understood what is reverse mortgage, why it is called as reverse mortgage. Now, what is the income tax implications? Now, here there are two income tax implications. One is capital gains. Your parents had a capital asset, which is this. This capital asset is transferred, sold to the bank, right? So both the conditions are satisfied. So technically, there should be a capital gain. But we are not treating this sale by your parents to the bank as transfer if it is done under this reverse mortgage scheme. Since it is not considered as transfer, so effectively there will be no capital gain. So first income tax benefit given to your parents is no tax on selling this property to the bank under the reverse mortgage scheme. Second benefit is here. Now, whenever the bank is paying EMI, it will pay some part of the principal and some part of interest. This interest will obviously income from other sources. We will study over there that over there also this is exempt. So this entire transaction in the hands of your parents is tax-free. First, the sale of capital asset is outside capital gain because it is not regarded as transfer, and the interest which they will earn every month on the EMI, that is also made exempt, and that is also kept outside the tax net. So this entire scheme is a beneficial scheme for parents, right? So this is what is the whole concept of reverse mortgage. Is this clear? Any doubts, students? Yes, so if there are no legal heirs, then obviously the properties of bank, because bank has already purchased it. Then what bank will do, like how they do of any other property, they will sell it in the market and encash their money. Understood, students? So our first leg is complete. What is the first leg? What is transfer? What is not transfer? Now we start with a very interesting part. The second leg. what is an asset? Because in order to tax capital gain, two things are required. One, what you have should be a capital asset. And second, the capital asset is transferred by you. Now, what all transactions will be transferred is what we studied in 247, read with all the exceptions given in 46 and 47 clauses to finally decide ki out of all the transactions, on which transactions the government wants tax, those are the taxable transfer transactions. Because few transactions are not regarded as transfer. So accepting those transactions, on remaining transactions, there will be tax. But when these transactions will lead to tax, when what you have sold, what you have transferred is firstly a capital asset. Now the question comes is, what will be called as a capital asset? It is defined under section 214 of the Income Tax Act 1961. Again, I'll repeat, in the new act, there are no substantial changes. The only cosmetic changes for which you may have to again put some efforts later whenever you will start studying the new act, obviously in the finals, that is the new section numbers, and maybe much better for us simplified language. So there are only cosmetic changes. There is no substantive changes. Yes, every year, whatever amendment the budget will make, that will happen anyways. It was happening in the old also over past so many years, 60 plus years, and that will continue to happen in the new act. So that anyways, you have to prepare whenever you are studying a subject of taxation. But the best part is, if you are thoroughly understanding now whatever old act we are studying, that will not be required to be revisited again. The concepts, the provisions remain same. Now, what is a capital asset? They have defined capital asset into three parts. Now, out of three, these two are specific. Specific means one particular item has been called as capital asset. They have been added afterwards as an amendment because the government want to, you can say, tax something which was going as non-tax. So see, this is how amendment happens. So when you start with the law, you define something. Later on, you find that for some reason, certain things are getting outside tax net. So you amend the definition by specifically including it. So these two specific items we can discuss and understand a bit later. Let me first give you what is the main meaning of capital asset. So what is capital asset? As per the law, it is all types of properties. Now, the best part is the definition is simple, three words, property of any kind. That's it. So whatever is a property, that is a capital asset. Now, what is very important, we as student of accounts generally understand that, okay, whatever is in my balance sheet on the asset side is only the asset. However, for the purpose of income tax, they have clarified that it may or may not be your business asset. So even the asset which is not part of your balance sheet can be a capital asset. So what is the basic requirement is that in order for anything to be a capital asset, we will call it as CA. Section 2, clause 14 simply says capital asset means property of any kind. And the second requirement, which I'm yet to explain, held by the assessee. This any kind will mean whether it is movable, whether it is immovable, whether it is tangible, whether it is intangible, and whether it is personal or of business. Everything, whatever is your property, is a capital asset. So simple and such vast is this definition. Any property. Now, interestingly, when we read this part of the definition, the question that comes is, okay, sir, maybe I will have capital asset once I start earning in future. No, today also, whatever is your property, it can be as simple as small as a pen. It can be as large as a motorcycle or your own mobile phone. All these things are your property. Please understand the vastness of this definition. I am not saying these are all taxable capital assets. Why? Because we are yet to see the exceptions. But firstly, to understand the effect and the vastness of this word, property of any kind, I'm trying to give you a very simple example. So today, now that is why this word becomes important. Whatever you are holding, whatever you are having, which you say कि ये मेरा है, that is your property. And that property, before we go to the exceptions, is your capital asset. Clear to everyone? So Arun Sagar beta, I repeatedly saying we are yet to go on the exceptions. That is why I'm already qualifying my sentence. But first, to make things clear, I have to give you an example, right? But again, your sentence is not completely correct. That is why I'm emphasizing the law has specifically said it may be business, it may be personal, right? So just tell me one thing, Arun Sagar. The house in which you stay, it is a personal asset, right? As per your understanding, whether it is a capital asset or not. Finally, the final conclusion after all exceptions, because maybe you know the exception. So I'm just asking you. So the house in which you stay, which is obviously your personal asset, not a business asset, is it a capital asset according to your understanding? That is why I'm saying. No? So that is why I'm saying, so you don't generalize. So now you are correct. So let us not generalize, correct? Okay. So students, understand this. So what is capital asset? Again, I'll repeat that we are yet to study exceptions. We are yet to find or reach to the definition of what are taxable capital asset. Taxable means after excluding the exceptions. But first, broadly, what is covered in capital asset? All your properties, which you are holding. Now understand, holding is a bigger word than owning. So you may not have purchased it out of your money, like how we normally say owning, but somebody has given it to you. Your parents have given to you, but today it is your property. That is sufficient. You will call it as a capital asset as per 214, right? Yes, there are exceptions, which I'm going to now deal with. After removing the exceptions, what is left will be the taxable capital asset. Taxable means on which tomorrow, whenever you sell it, transfer it, you will have to pay capital gains tax. Now, what are the exceptions? So it says, however, we will not include some items in the definition of capital asset. First is simple stock in trade. The answer is why we will not include stock in trade? Simple, because whenever you sell stock in trade, the earning, the income that you get is PGBP. Right? So why it is kept outside? Because whenever you will sell your stock in trade, obviously stock in trade is something in which you deal, which is your business goods. So whenever you will sell it, you already have an head to tax it. In fact, that is the specific head to tax it. So there should not be a double taxation. Hence, the first item, which is a property for you, is excluded for the obvious reason that it is already getting taxed under PGBP. In fact, PGBP is specifically created for taxing this. So the goods in which you deal, in which you trade, is what is your stock in trade. And we do not want to consider it as a capital asset. Now comes the most important exception. Personal effects. Now, when I was just explaining you the vastness of the definition of capital asset, when I was on the word property, I gave you example that the pen which belongs to you, the motorcycle which you are having, your mobile phone, your laptop, everything is capital asset, right? But they are not taxable capital assets. Why? Because of this second exception. So this second exception says, whatever are your personal items, What did it mean by personal effect? Personal effect means those items which you are holding for your personal use or used by your family members. And most important thing, it should be movable. So exception is whatever are your movable personal items. Now we come back to the same point. Now, whatever examples I had given you earlier to explain you what is a property, majority of them will be excluded. That is, they will not be treated as a capital asset. So the pen that you are having, the specs that you are wearing, your clothes, your day-to-day use items, furniture items, laptop, mobile phones, all these are movable, yes, and they are held by you for either your own personal use or used by your entire family. It is personal effects and it is not treated as a capital item. That is, it will not be a taxable capital asset. Now, interestingly, we have an exclusion. So we are already reading an exception, what is not a capital asset. And for this exception, you again have an exception, which finally means that what you are now going to read are taxable capital assets. So firstly, they have said that what will not be included in capital asset are personal items, but if the personal items are any one of these, they will be considered as a capital asset. Now, I'm sure you'll accept this point that whatever jewelry items you are using may not be on daily basis, but you are having jewelry items, some which you are wearing every day and some which you may be wearing occasionally. They are all your personal use items. However, the law has excluded it from this exception of personal effects. It means they become your taxable capital asset. So, what are these personal items? Jewelry. Then, in your house, many times you have some very expensive drawing, some archaeological collections. People decorate their house with this, right? Some paintings of some great painters, or some sculptures which they may have purchased from some places, or any work of art. Many times these things are kept in your house for decoration. All these things, even though your personal items, we want to tax them. So if I have to give you in nutshell, what is capital asset out of personal items? So personal items, but which are capital asset. What are they? Your house. So it is a personal item, yes. But why it is a taxable capital asset? Because here exception only included movable. House is immovable. So your house in which you are staying is a taxable capital asset. Further, jewelry. Further, paintings, sculptures, and all these items which are mentioned here. So out of all your personal items, these few personal items will be taxable tomorrow whenever you sell it. But other than these personal items, which are listed here, other than these, if you sell any other personal item, it will not be taxed. I hope this point is clear to everyone. Anybody having a questions, may please ask. See, Dhanalakshmi, you are correct. So we are right now discussing only what is capital asset, what is not capital asset. But today, let us say in this definition, even though I'm saying jewelry is a capital asset, but tomorrow, if you give the jewelry, whether there will be capital gain? No. Why? Because gifting is not transfer. Similarly, if any of these paintings are of national importance, they are these archaeological collections are declared by the government as of national importance. And tomorrow you sell this to government or to some national museum or any of these governments, national bodies. Again, there will be no tax. But still, these items will remain taxable capital assets. So keep in mind, there are two separate conditions. One, the item should be a capital asset. I'm using the word taxable capital asset, and you should have transferred it. So you are satisfying one condition, that jewelry is a capital asset. Archaeological collections, paintings, drawings are capital asset. Yes. But tomorrow, if it is not considered as transfer, why? Because you have gifted it, or these items which are declared of national importance, you are giving or selling it to government, then obviously there is no tax. Enam bida, what you don't understand in personal effects. That is why firstly I gave example. Today, whatever right now also, whatever you are having with you are all your personal effects. Whatever you are using day in, day out for yourself, Enam, is your personal effect. Is that clear? Enam, you are using day in, day out. Right now also you are having so many things with you when you are attending this class. So whatever you are using day in, day out, everything is personal effect. Correct? Clear? Now, interestingly, your personal effect, one of the personal effect which will be treated as a capital asset, is jewelry. We have seen here that jewelry, if you have, even though it is a personal use jewelry, it will be a taxable capital asset, right? Now the question is, what will come under jewelry? Interestingly, under this same section, by way of an explanation, the law has defined what will be jewelry. So now we need to understand this definition. Anshul is asking, sir, why there is such a distinction that jewelry is treated as taxable, whereas laptop, mobile phones are not treated as taxable. See, Anshul, the reason which I can give you, which I also believe is the reason of the tax authorities, is that laptops, mobile phone, your dress, your specs, these items will not have any substantial value whenever you go to sell it. But jewelry is something whose value will definitely be increasing over a period of time. In fact, if you just see last 1 year back, gold was 50, 60,000. Today, if I'm not wrong, gold is 1,50,000. So in hardly a span of a year, the price has tripled. So that is why they have intentfully kept jewelry out of the exception. In other words, jewelry has been treated as a taxable asset because over here they feel that one, it is going to be valuable in future, rather the value will keep on increasing. Second reason, Anshul, main reason, if you see, many times people are purchasing jewelry not with the intention only of personal use. In fact, our Indian mentality, we have a special attachment to jewelry, not only because it is beautifying us, but our main reason of purchasing those jewelries, we have this at the back of the mind that let me purchase it today. It will help me in my beautification. Plus, whenever I sell it in future, I will earn only. So somewhere they have that commercial mind whenever they are investing in jewelry. That could be the reason why they have distinguished and kept these few things out of the exception and made them taxable. Right, beta? Now, they have defined jewelry so that there is no confusion with anyone. What should be treated as jewelry and what should not be treated as jewelry. So see how they have defined. So for the purpose of this section, they have said that the expression jewelry will include the following. So first is all ornaments. Now what are ornaments? So whatever you are wearing, it may be necklace, bangles, earrings, nose rings, all these type of things which are made of any precious metal. So it may be gold, silver, the most common one, or the new upcoming one, platinum, or if there is any precious metal in future, which may be treated as precious. So if it is made of that precious metal, and then it is clarified whether or not. So it may have some precious or semi-precious stones or not have. So some of your jewelries may also have embedded some diamond, emerald, that is also jewelry. And some are only plain nose rings, earrings without any diamond, emerald or moti. Still, they will be jewelry. So having a precious stone is not a compulsion. It may or may not be there, but that item should be made out of precious metals. Also, they have clarified that it may or may not be sewn into wearing apparel. Now, this is interesting part. Now, you'll say, sir, what is this? So let me tell you, we have, you can say, tradition or now a prestige point that if I'm super rich, I will wear the same type of clothes what you are wearing. Maybe brand wise or quality wise, it may be something very high. But still, if I want to show off my richness, what I will do, the buttons which I am using can be made of silver, gold. The cufflinks which I am using can be made of silver, gold. So many times I may use a brooch on my dress, which is of gold. So people use certain of these items which are sewn into their wearing apparel. So whether or not it is sewn, in both cases. So in short, wherever wearing apparel has any precious metal which is sewn into it, like I can compare it with another example. Earlier, before British era, when we had all these Raja Maharajas, many of their dresses were sewn out of gold, silver threads, or they definitely had many of the things attached in their dress. Then such dress will also be treated as ornament. Now, interestingly, I'll now tell you something very interesting. So first, what we understand in this is ornaments, and whenever we say ornaments, we visualize only necklaces and all the items which we call as jewelry, which is correct. But what they have clarified, something which is sewn in your dress is also jewelry if it is made of gold, silver. Now I'll add one more thing. What will come in this first point is, let us say the specs which I'm having. I'm sure you all know that specs also are made of gold, silver, original gold, silver. Yes, again, some people may have some diamonds studded on these specs, may or may not, but many times you'll find this is very common having original gold frames or maybe frames which are gold plated. Similarly, silver frames. So, interestingly, these frames will also be treated as jewelry. Why? Because when we read the word ornament, we only visualize necklaces, bangles, etc. But if you see the dictionary meaning of ornaments, it is much, much wider. So anything which is for your beautification, maybe in the form of some necklace or anything, or even something like specs, all these things are treated as jewelry. Let us say you have a watch which is studded with diamonds. That is also jewelry. You have a watch whose dial or the belt is made of gold, silver, jewelry. Correct? Now comes the second interesting part in jewelry. If you have any furniture or utensils or similar other articles, so now we are talking about furniture, utensils, articles. Generally, we don't call them as jewelry, correct? But if they are studded with precious or semi-precious stones, then even such furniture, utensil, or articles will be called as jewelry. So, first is your ornaments, second is furniture, utensils, articles. But what is important to be noted is there is a difference. For ornaments, the condition is metals, may or may not be with precious stones. But for furniture, utensil, and similar other articles, the condition is there should be precious or semi-precious stones studded. So, interestingly, now pay attention. Your ornaments, jewelry, bangles, gold-plated frames, all are jewelry. But interestingly, if you have a gold or silver spoon, many times you have the entire set of silver utensils like silver plate, silver cups and saucers, silver glass, silver spoon. Normally we have in our Indian families. They are not jewelry. Pay attention, they are not jewelry. Why? Because for utensils, the condition is not metal. The condition is precious, semi-precious stones. So see the difference? Just keep it in mind. At inter level, this much in-depth analysis of this definition is not required, but definitely at final level, where your questions are more case study based, legal judgment based, this particular point which I've explained just now will be a very important point. So just since we were discussing ULV, I thought I'll just inform you about this slight difference which is coming out from the definition. Is this clear, students? So, two exceptions we have seen which will not be treated as an asset. One is stock in trade, one is personal effect, but within personal effect, few personal effects will be treated as capital asset. That you should keep in mind, that these are few personal effects which are capital asset. Other than these, remaining are not. Now coming to the third exception, which is not a capital asset. If you have an agricultural land which is not in urban area, interestingly, the land should not be in urban area. This is what the law says. To simplify it, we have said rural agriculture land. Provision is not saying that. What the provision is saying, any land which is not in the urban area. This is how the definition or this point is made. So now what we are going to discuss over here is the definition of urban area. If your land is not in these areas, it means your land is a rural agriculture land and it will be outside the definition of capital asset. So even tomorrow, if you sell this rural agriculture land, I will not tax it. Now, what does the law says? Agriculture land which is situated within the specified urban limits would be capital asset. So what is not capital asset? Which is not situated in this urban limits. Now, what is an urban limit, or in simple words, what is urban area? So the area which is falling within the jurisdiction of a municipality, cantonment board, and where the population is not less than 10,000. Now, all our cities are urban areas as per point A. Why? Because they are either having a municipality, municipal corporation, or if it is a military area, it is having a cantonment board, which is running that area, which is maintaining that area. Correct? And all of our city's population is 10,000 or more. So the city in which we all are staying, it may be a small town place. It may not be a very major city, but still it is an urban area as per this definition. Right? Now, interestingly, let us say this is your city limits. Now, this city is having population of 10,000 or more and having a municipality. So we have declared this city as urban area as per A. Now, interestingly, what does B says? Not only that particular city or area, but areas beyond that will also be urban area if they are within this range of 2 kilometers, range of 6 kilometers, range of 8 kilometers. So many times we see that beyond your city limits, the rural part starts. Correct? This is very common in many places. So you have one city or one small town, and after that, again, you have everything which is rural. Rural means you'll only find kacha roads, you'll find all the types of grazing lands or the farmlands. And then again, after a distance, again, there is a small city, right? Now, in such cases, that city is urban if this condition is satisfied, which many times will be satisfied because now 10,000 is not a big number for population and many times they have municipalities. But immediately once the city ends and now you start having those kacha roads and those farmlands, whether that part is also urban. So for this, what does point B says? Point B says that wherever your city limit ends, some part beyond the city limit, some part will also be considered as urban. How much part? So if your city's population is about 10, but below 1 lakh. So your city's population is exceeding 10 because that is the basic condition for becoming an urban area. So your city's population is about 10,000 but less than 1 lakh. Then beyond your city limits, up to 2 kilometers will also be considered as urban. If your city's population is exceeding 1 lakh but below 10 lakhs, then up to 6 kilometers beyond your city limits will be considered as urban. And if your city's population is above 10 lakhs, now this will cover all major cities of India, then besides or beyond your city limits, up to 8 kilometers will be considered as urban. So, in short, as per A, this is urban, and as per B, some area beyond your city limits will also be urban. But how much area beyond your city limits will be urban? That depends on the population of the city. And on that basis, they have identified up to what radius beyond your city limits we will consider as urban. I hope this is clear. Yes, students, is this clear? The definition of urban area. Yes, great. Now Arun is asking, sir, if when I had purchased that asset, it was agriculture land. Now, as the city start expanding, we convert the agriculture land into a normal land, that is a non-agricultural land, which can be then used for residential, commercial, whatever purpose. So if your land is later on converted from agriculture to non-agriculture, and then you sell it, what will happen? Answer is you will be outside this benefit because now your land is no more agriculture. It is now commercial. It is now residential. So whenever you sell it, it will now be outside this exception. It means it will be treated as a capital asset. Is this clear? Now, interestingly, point B says that agricultural land situated in any area within this range of 268 kilometers measured aerially. So, how do you measure this distance? Through GPS, like how our Google Maps and all these maps are measuring. So, when you measure the area aerially, that distance will be checked and not the physical distance. Because many times the physical roads are teda meda, they are not going straight. So when we are measuring this 2 kilometer, 6 kilometer, we will measure it aerially. And then few more exceptions which will not be treated as capital assets. Why? Because the government, these are all government bonds, and the government wanted people to invest in these bonds. So whenever these bonds were issued, the government said that in future, when you will sell these bonds, there will be no capital gain because we are keeping it outside the definition of capital asset. So first is specified gold bonds, special bearer bonds, gold deposit bonds. So these are three types of bonds which are to be kept outside the definition of capital asset. So as you can see, property of any kind, and then these are the exceptions. Out of this, the most significant one is this when I'm talking about exams. Then after that, this remaining you can just keep in mind that they are also outside capital asset. Again, within personal effect, few things are treated as capital asset because they are exception to personal effect. So these items, if you are having, even though they are your personal items, they will be regarded as a capital asset. So I hope students you have understood what is a capital asset. I've still dealt with this part. We have still to deal with these two, but these two are very specific that we will discuss. But first, is this part clear? Anybody having any questions with this main part of what is capital asset and what are the exceptions? Students, is it clear? Everyone? Yes? Excellent. So now we'll have a break of 10 minutes. And after the break, we come back and we deal with the further provisions. Fine? Now suddenly all why? Why? See, what got you confusion was this word private, correct? Suddenly when I said shares of and then I paused and said private, some doubt crept into your mind. So this is where our knowledge understanding of the subject is very important. Please understand, students, share, whether of a public company or a private company, is always your property. You can sell both. The only difference is public company share can be sold easily. It is also listed in the stock market, so it is even more easy to sell it. Private company cannot be sold directly across the market, but it can be sold. It is not that it can never be sold, right? And the law has not made any distinction either in the definition or any other point that whether it is an asset or not. So anything which is your property is an asset. So even a private company share is a capital asset. Anchal is saying, sir, but section 46(1) share is not taxable. Sorry, beta. Go back and see whether share is not taxable in 46(1). I don't think we have discussed in 46(1) share is not taxable. In 46(1), the company giving away its assets, its plant, machinery, building, furniture to the shareholders is not regarded as transfer. Again, please don't mix between asset and transfer. Right now, I'm talking about asset. Even if right now, if I have to answer your question from the perspective of transfer, that you are saying it is not taxable, but what you have said that share is not taxable under 46(1), Anshul, it is not correct. Under 46(1), the assets given by the company is not taxable. So company is giving assets to the shareholder is not taxable. Now let me tell you, interestingly, there is another section 46(2). So 46(1) is from the company side. Now in the same transaction, the other side is of shareholder, because shareholder is receiving asset because it has given something. What the shareholder has given to the company, it has given it shares, and in exchange, it is receiving assets from the company, correct? Interestingly, 46(2), which is from the shareholder side, is taxable. So what you are saying is not correct. Okay? Coming back. So shares of private company, shares of public company, listed shares, unlisted shares, preference shares, equity shares, all shares. Answer is why. What is why? It is a taxable capital asset. Public, private, listed, unlisted, all shares. Asset. ठीक है? Now, next point. Your personal jewelry. You have to just say Y or N. Good. Mehak, why is it N? As I said good, suddenly I got a no. Ariva, I got another no. Why Anil, it is not a capital asset? Why Inam, it is not a capital asset? Suddenly I'm getting no. The moment I said good, because I was seeing why, suddenly I'm getting no. Anil, why it is not a capital asset? What is the problem in my personal jewelry being a capital asset? Enam, why it is not a capital asset? So Enam, we have seen some exception to personal effects. So Arun, why no? No means what, Arun? I am not getting. So you are saying it is not a capital asset. It is a capital asset, beta. How come it is not a capital asset? Personal jewelry, capital asset. Tomorrow you sell it, you have to pay tax. There will be capital gains. Yes, Arun, how is this possible? First, they are saying if it is goods, why it is not goods? I am simply giving you a simple situation. Your personal jewelry, I am very specific. You cannot give me answer if it is like this. I've given you the situation. You're changing the situation. Okay. Second scenario in this, I am running a jewelry shop. The jewelry which is kept in my shop, capital asset, yes or no? Anshul, it is why you are saying yes now. So the answer is it is not a capital asset. Why? Because it is a stock in trade. And since it is stock in trade, it is not a capital asset. Correct? Good. Next question. Next item. Same question. Whether capital asset, yes or no. The next item is factory building. Good. So it is a capital asset. Yes. Great. Motor car, which is purchased by this same factory. So the factory has purchased few motor cars for transportation of its directors, managers. So some cars are purchased by the same factory. Whether these cars are capital asset. Tanisha, Mehak are saying no. So Tanisha, Mehak, why this motor car, according to you, is not a capital asset? Because all others are saying yes. Yeah, I'm not saying they are right and you are wrong, but only you two have a different answer. So I'm asking you both. Why do you feel that this motor car, which is purchased by this factory for transporting of their directors, managers, their transportation? So Tanisha, whether all movable properties are not asset, because you are giving me answer as movable property. So is it your answer that all movable property are not asset? Tanisha, Mehak, where is it personal use? This car is purchased by a factory, which is a business. And when the factory is using the car for transporting its directors, their traveling, the traveling of their managers, how is it personal? Is it not for their business purpose? So, Kambhira, finally what? Capital asset or not capital asset? For the purpose of capital gain. The answer is it is a capital asset. Now, in this example, again I'll extend. One of the directors of this factory has her own car, which the director has purchased out of her salary. Whether this car belonging to that director, whether her car is a capital asset. Vishakha has said yes. Anchal has said yes. Many others have said no. Then Lakshmi has also said yes. Now, since you three are having a different answer, I'm asking you all whether why you feel it is not a capital asset. Sorry, why you feel it is a capital asset? Sorry, you all have said yes. So Vishakha, Anshul, Dhanlakshmi. So Anshul beta, then everything which is having a market value is an asset. But have we read any such thing till now in any of these sections, provisions which we studied? Everything has a market value. There is some value to everything. So whether the car which is purchased by the director, her own car, is it a capital asset? Then Lakshmi, so there are no exceptions to this. The car purchased by the director for her own self is not a capital asset. Yes, then Lakshmi, I agree. It is a property of any kind, whether business or personal. It is a personal property, right? But we have an exception to capital asset. And the main exception I already said is personal effects. If anything is your personal property, it is movable. It is not a capital asset. We just saw that. You still have that definition on your screen. And see, I've marked this. Out of all the exceptions, these two will be commonly be tested in exams. So Dhanlakshmi, whether this exception will not apply. Yes, Vijay, what is your understanding? So whoever said yes, now I am not able to search because I have long list of answers. So I think Vishakha, Dhanalakshmi, and Anchal, you three were saying yes, but no, it is not a capital asset. It is a property, agreed, but it is falling in this exception, right? Now, continuing the example, the same director whose motor car you said is not a capital asset. We concluded it, we understood it, right? Now, I continue the example. That same director goes and purchase a diamond necklace. Whether her diamond necklace is a capital asset. It is for her personal use, obviously, because she is not into any business. She is a salaried person. This necklace is her personal use asset. Whether this necklace is a capital asset. Vedant and Enam are saying no. Majority, all other are saying yes. So Vedant and Enam, can you give me your reason? Why you feel that this necklace purchased by the director for her personal use is not a capital asset? Why do you feel so? So Arun Sagar, how that is relevant here? Vedant, you are saying it is for personal use. Okay. So Vedant, what about the exceptions to personal effects? There are 5 exceptions where even personal items will be treated as an asset. Is your item not in the exception? Again, Enam, but this is not the answer. This was a reason I had given just to help you keep that concept in mind. But you cannot keep this answer in mind because that may give you wrong answer for other items. So my question is, Vedant, she has purchased this necklace, and obviously necklace is her personal asset. Why? Because she is not into any business. So it is for her personal use. So it is or it is not a capital asset. Answer, it is a capital asset. Why? Because we have exceptions to this exception. So personal assets are excluded from capital asset, but there are some exceptions to this. Means these personal assets are capital assets. This is what we have concluded. So out of all personal effects, these personal effects will be treated as a capital asset, and jewelry is one of them. I hope Vedant it is clear to you. I hope Enam you have got the correct reason, because jewelry is specifically excluded from personal effects. That is why jewelry, even though personal effect, will now be treated as a capital asset. Continuing this example further, director buys a very expensive Mac Pro laptop for her personal use. So since she is drawing handsome salary, she purchases a very recent model, let us say of some 5 lakh rupees Mac Pro laptop. And this she is going to use for her personal use, obviously, because she's not into any business, she's an employee. Whether this laptop, and let us say she also buys an iPhone, the latest model, iPhone 16 Mac Pro, again for around 2 lakhs. Whether this mobile phone, this laptop is a capital asset. You can give different answers if you feel for laptop and for mobile phone, there are different answers. You can give that answer. Great. For the first time, we are having 100% consensus. So nobody is having a different answer. So all are saying no. Both these are not capital asset. Very good. Now let us say, seeing that laptop, the factory, the company decides that yes, this is a good laptop. Let us buy few of these laptops for giving to all our directors so that they can use it whenever they are in the company, in the factory. And since these laptops are having good proficiency, good working capability, so the factory, the company buys 5 laptops for their 5 directors. These 5 laptops purchased by the company to be given to their directors for using it whenever they are in the company, the factory. These laptops are asset, yes or no? Great. Again, for the first time, we are having a full house consensus. Excellent. Great. So now I'm sure you are understanding what is and what is not a capital asset. Now, we studied how to decide whether the asset is short-term, long-term. So for that, we have the 12 months and the 24 months rule. Plus, we have an exception whereby these assets are to be always regarded as short-term. And other than these assets, for remaining assets, few are in the 12 months rule, few are in the 24 months rule. Now, an interesting part. We just saw that for finding out whether your asset is long-term or short-term, you have to count the period of holding. And that period of holding, 12 months or 24 months, depending upon the nature of asset, you will check. And wherever it exceeds the 12 months, 24 months, you will call it as long-term, right? Now, this is the period of holding. What is this? Date of purchase, that is acquisition, and 1 day immediately preceding the date of transfer. So this is the date of transfer. 1 day immediately preceding that. This period is called as period of holding, right? So what is the general rule? The general rule is period of holding is this period. It starts with the date of acquisition and ends 1 day prior to the date of transfer. Now, this is the general rule. Now, this rule has exceptions. In some cases, period of holding will be determined in a special manner. All these are given in explanation to the section 2, clause 42A. Now, let me tell you what is 242A. 242A is the definition of short-term asset. So what we saw about 12 months, 24 months, all that is given in 242A, that where your period of holding is not exceeding 12 months, 24 months, it will be short-term. And then the definition of long-term says whatever is not short-term is long-term. And in 242A, we are given some exceptions. Exceptions means that the general rule is period of holding will be counted from this date to this date. This is the general rule. However, this rule is having some exceptions. That is, in some cases, the period of holding will not be counted from here to here, but from a different date or for a different period. Now, what are these special cases? First case, if you remember, companies under liquidation. Now, just recently, I was answering somebody's question. Somebody said that when a company is under liquidation, then there are two things. Company is giving its assets to the shareholder, which is not a transfer. But somebody was saying that the shareholder, when it gives away its shares, obviously the shareholder is giving back the shares and it is receiving the asset. So for shareholder, giving of the shares back to the company at the time of liquidation is also not transfer. This somebody was telling me, which I corrected. This is transfer. See, we only studied till now 46.1, which is dealing with company side. Now on company side, whatever assets the company is having, it is giving, it is not transfer. But from shareholder side, whatever shares the shareholder is having, it is an asset and it is a transfer. Now relating to the shares of the shareholder, there is a special point on period of holding. What is this point? Now for this, let me give you an example. So the shares are purchased by the shareholder on 1st of October 25. And today, that is on 16th of June 26, the company goes into liquidation. So you purchase the share last year on 1st October. On today's date, the company goes into liquidation. Now we all know what happens. When the company goes into liquidation, you will get your money back, not immediately. Your number as a shareholder comes at the last. When you give back your shares to the company and you get back your money, whatever is left for you, right? Now, this happens on 25th of December 26, because after liquidation, the company has to first pay off its outside liabilities, statutory, non-statutory, everything. And the last is your number. So by the time your number comes, it is 25th of December. Now, interestingly, your date of acquisition is this, and the date when you give back the share is this. So 1 day prior to this, up to this date, normal rule is that the period of holding should be. However, the special rule is that the period from this period, date of liquidation, till the date you are actually giving back the shares, will not be counted while deciding period of holding. So what will be excluded? Period after the date liquidation starts. So here the exception to our rule of period of holding is that normally period of holding should be counted from date of acquisition till 1 day before transfer. But here it will be only counted from date of acquisition till 1 day before liquidation or up to the date of liquidation, because the period after the date of liquidation has to be excluded. I hope you got the first exception, right? Now let me come to the third point. Now pay attention. We have seen one case, capital asset converted into stock in trade. We know that this is transfer. But do you know there is a reverse case also? Stock in trade converted to capital asset. Same thing, reverse. So whatever is your stock in trade today, let us say you change the line of business, and that is now to be treated as your capital asset. I'll give you an example. I am into buildership. So I've constructed shops and offices which I'm selling. So whatever shops and offices I've constructed are my stock in trade. Now I've completed one building, one project in which two offices are left. Remaining all are sold out. So logically, as on this date, these two offices are my stock in trade. Now I decide to change my line of business. I don't want to be a builder anymore. And I start a new business where, let us say, I'm going to do share trading. So I change my line of business, and these two shops which were unsold, I make those shops as my share trading business's office. So those two shops which were with me till date, I was a builder, were appearing in my books as a stock in trade. But now I have closed down that business and I've started a new business where I'm going to do share trading. For this business, the two shops are now becoming my office where I will sit, my staff will sit, and I'll do the share trading business. Now, in this case, what has happened? I've converted the stock in trade into a capital asset. Now, this was covered in the definition of transfer and hence ultimately covered in capital gain chapter. This is covered in section 28 and hence treated as PGBP. If you recall, while studying section 28, I had purposefully left one thing pending. And I had said that we will discuss it later. I could have explained it at that time itself, but maybe you may not have understood it so well. But after understanding this point in capital gain, that is conversion of capital asset into stock in trade, now if I tell you that there is a reverse possibility, what is that reverse possibility? The reverse possibility is this. Inventory, that is your stock in trade, converted or now treated as a capital asset. So now it is the other way around. Stock in trade, now converted or treated as capital asset, right? So if this conversion, capital asset into stock in trade, can be treated as transfer and leading to capital gain, why not the other way around? Stock in trade, now treated as capital asset, should be treated as a transaction of PGBP, and why it should not be taxed in PGBP. So the law says we will tax it. I hope this is clear. So this one point which I had kept pending in 28 purposefully is also done. So what is covered in 28? Wherever your stock in trade, which was held by you as stock in trade, is now converted or treated as capital asset, this will lead to PGBP income, and for that the value to be taken is fair market value. I hope this is fine, students. Now coming back to our present point. Now what is the present point? I have converted my stock in trade to capital asset. Now again, once it is a capital asset, I have to decide the period of holding. Again, say this is the period. So I have purchased or constructed this shop in my example when I was a builder. Now I close down my buildership business today. Let us say This was constructed. This entire building project was completed on 1st of January 26. And today, on 26th of June 26, I close my business. Close my business and I start a new business. So I close and I start. Which business I have closed? I have closed the builder or the real estate business and I've started the share trading business. Now, what has happened in this? Whatever shop was left unsold, now I want to show or treat that shop as my asset, which is okay. This treatment, this conversion will be taxable under PGBP. Yes. Now, this particular shop has become my capital asset. And let us say in future, after a few years, I want to sell it because I want to shift to a bigger place. So I will sell it on some date. Now, when I'm selling this shop in the future, how to determine period of holding? Originally, what we have understood, date of purchase till 1 day prior to the date of transfer should be period of holding. But in this special case, where originally when I purchased or constructed, it was my stock in trade, and on this date, it became a capital asset after I converted it. Converted it means started treating it as my own office. So the law says the earlier period till the date it was your stock in trade will not be counted in period of holding. So your period of holding will be considered from this date onwards. This will be your period of holding. And that if exceeds 24 months, you will call it as long term or else short term. So what is given? Period from the date of conversion or treatment as capital asset shall be counted. That is the prior period shall not be counted. And if you think logically why it is not counted, because at that time it was not a capital asset for me, it was a stock in trade. I'm not counting that period. See, all these points, if you understand with a logic, with a proper example, it will not be very difficult and technical. Then it will become okay, obvious, acha, barabar hai, logical, right? So understand things with logic. Now coming to the next case. We all have heard this word, right shares. Now, what are right shares? Originally, you are having some shares. Let me call it as original shares, which you had purchased. Now the company offers right. Now, what is the law saying? Company's law that whenever you are bringing in new issue of shares, you have to compulsorily first offer them to your original or existing shareholders. If they buy it, fine. If they are not ready to buy it, only then you will offer it outside. And this shares which have to be offered compulsorily to your existing shareholders is called as right shares. Now you had purchased this share long back, somewhere in 2021, and now you are offered the right shares. You take that option and you purchase these shares today. Now, when in future you will sell these shares, the question is period of holding has to be counted from this date or it has to be counted from this date. Now, again, if you think logically, this and this are two different shares. I had purchased this initially and now I have got new shares. I'm purchasing further more new shares. But just to avoid confusion, for a clarification, this fifth point says that when you are counting the period of holding, it will be counted from this date. And it is again obvious because I will not go back to the previous date because that is another share. I will sell it separately and I can share this, sell this share separately. Both are two different shares. So the previous share, the original share date will not be counted. What will be counted is the date of allotment of this new share. So such share means the new right shares. In short, logically, period of holding will be counted from here onwards, not from the previous share. Now, continuing the same point. Now, before you purchase the right shares, you are given the rights. So the company gives you the rights, and using these rights, you purchase the right shares. Now, if you remember your accounts, you have studied in the chapter on shares and debentures, which was as per AS 13. If you remember, we have solved those sums, if I'm not wrong, at foundation level itself. In that, this type of question or adjustment was there, that the company offers you rights. Rights means rights to purchase the new share. Now, first option is you have purchased the share, point is over. But second possibility is you don't want to purchase, you sell the rights itself. So in point number 6, what you are doing, you are selling the rights. You're not purchasing the right shares, you are selling the rights. Which rights? Rights to purchase that share or security is renounced. Renounced means sold off. Now, when you are selling off the rights, now anyways, you'll not have the right share. Again, the question is whether this sale of rights will be taxed. Yes, because right is also your property. It is an intangible property, and we have already seen property, whether tangible, intangible, both are capital asset. So even rights which are offered to you are also your property, also your capital asset. So whenever in future you will sell these rights, there will be a capital gain even on the sale of rights. Now, if rights is a separate capital asset, so I'll have to find out capital gain separately. So the question is, from which date will I count period of holding of the rights? The answer is the date on which the company gave you the rights. So there is always a letter which you receive from the company saying that we are giving you the rights to purchase the shares first. If you take the shares, fine. Otherwise, we'll sell it to outsiders. So the date on which you have received the letter from the company giving you the rights, that date is the starting point of counting the period of holding, which is again logical. Next. Like right shares, you have another concept of bonus shares. Again, here you have an original share which is purchased long back. Now, today, the company wants to give a share free to you. Why? Because you are my original shareholder. Today, I want to give you another share, but this share will be given free, that is without any payment. Now, the question is, in future, when you want to sell the share, you have two shares. One is original and one is bonus. Now, whenever you will sell the bonus shares in future, the period of holding of this bonus share will be counted from which date? Whether it should be counted from the original share date, the answer is no, because both are separate assets. You will count it from this date itself. So that is what is clarified, that in case of bonus shares, the period of holding will again be counted from the date of allotment of such shares, that is the bonus shares, and not the original share. Right? Next special point is, again, you have a special type of share which is called as ESOPs, right? Or in other words, sweat equity shares. So we call it as ESOPs, employee stock option plan shares, or in another language, we call it as sweat equity shares. Now, generally, these are given to the employees of the company, where after a particular period of time, if you have been in the company says, I will give you some shares of my company either free or at a discounted price. These shares are called as ESOPs. Now, you are my employee. You have been serving me for last 5 years. Today, your 5 years are completed. So, as per the policy of the company, since you have completed 5 years, today I am offering you my shares at a very low price or free, and you take these shares. Now, whenever you will sell these shares in future, the question is from which date the period of holding will be counted. Again, the obvious answer is this date. That is the date of allotment of such shares, which we call as sweat equity shares or ESOPs. So, right shares, bonus shares, ESOPs, all these special type of shares, the point is you will not go back in the date. Here you will not see, okay, I was employee, I had become employee 5 years before, so from that date I will count. No. These are all independent, these are all new assets. So you'll count their period of holding from the date when these new assets come into existence, not the previous date where the original asset was there. So I hope you got these three special cases. All are dealing with shares. So I've covered them together so that logically keeping in mind, see, so I'm not going by the logic of the act, I'm going by my logic. So I'm trying to bring similar things together so that keeping in mind learning also becomes easy, right? Now coming to all the remaining cases. So what cases are remaining? 2, 4, 8, 9, 10. Within 10, there are two parts. That's it. Now for all these remaining points, I'll give you my first golden rule. Now I'll say, sir, what is this golden rule business? So for capital gains, I'm using a concept called as now what is a golden rule? A golden rule is that point or statement which applies to multiple sections in the same fashion. Means if you remember this one sentence, one statement, multiple number of sections you need not learn separately, they are all covered here. My golden rule 1. What is golden rule 1? Where any asset means obviously capital asset, is acquired or received by you in one of the modes which is not regarded as transfer. So what is the golden rule dealing with? It is dealing with that scenario where you have purchased the asset in one of those modes which we studied in the previous class and revised today, that these all modes or mediums are not treated as transfer. Like somebody gifted you an asset, so gifting is not transfer. You received some asset under the will of your parents or grandparents, which is not transfer. Or you are a 100% subsidiary company, the holding company sold their assets to you. Or you are an under amalgamation, you are the shareholder of the old company, you gave back the old shares and in exchange you receive the new shares. All these scenarios are not transfer. Now, if you have acquired any capital asset in one of these scenarios, one of these modes, which we have seen as not transfer, what is the law saying? The law says your cost of acquisition is cost of acquisition of previous owner. Now, today we are not studying this point of cost of acquisition, but just have written it here. And second, your period of holding will include period of holding of previous owner. At this point we are discussing. Now, what is this point? Let us understand. So, I'll give example here itself. So, father has purchased a house property. HP purchased by your father on a date. Now, father had this property for a long period of time. Then, today, the father gifted this property to you. Right? Now, it becomes your house property today. And later on, you sell it, you transfer it. Now, since you are selling it, you are transferring it, you have to pay tax. Father had gifted the property to you, which is not transfer, so father did not pay any tax. Now, for this property, we want to find out your capital gain. Now, while finding out your capital gain, I have to also find out whether this is a short-term asset or long-term asset for you. Now, the general rule is, how do we count period of holding? We count it from the date on which you acquired the property, which is the date of gift, till 1 day before the date of transfer. So, as per the original rule, this period should be your period of holding. However, what is the golden rule which I have given? That if you have received any asset, one of the modes, one of the scenarios which we have studied as not transfer, and gift is one such scenario, gift, will, inheritance, all these are not regarded as transfer. Now, when you have received the asset under gift, under will, under inheritance, it means while receiving it, it was not treated as transfer. Or in other simple words, the person who gave you the asset did not pay any capital gains tax because for him it was not a transfer. Then for you, the previous owner's period of holding, this is the previous owner's period of holding, this will be counted as your period of holding as well. So in short, your period of holding will be counted from this date to this date. So your period of holding is counted from the date the previous owner had purchased, or in other words, the period of previous owner is also included in your period to find out your total period of holding. I hope this is clear to you. I hope this point is understood to you. Yes, if you have understood it, let us read. Now, point number 2 here. Asset becomes a property of the assessee under 49.1. 49.1 covers all these cases, gift, will, inheritance. We'll study 49.1 later. So what is the point? Asset becomes your property as per 49.1, and 49.1 covers all these scenarios which we studied in not transfer. The period for which the capital asset is held by the previous owner is included. So your period will be counted including the date of previous owner. Correct? Next scenario. You have received shares when the company was getting amalgamated. Now we have studied that what will happen when your company will get amalgamated. You will give the old shares and in return you will get the new shares. Now this exchange of old to you is not treated as transfer, right? Now you are having new shares. The period of holding of the new shares will include the period for which the old shares was held by you. So you may have received the new shares today after exchange. So you gave back old shares and today you receive the new company shares. But the period of holding of this new company shares will be counted new company shares. This period will include the period for which you were holding old company shares. So even though I've got the share today, but this I have received at the time of amalgamation by giving my old shares, I got in exchange the new shares. The period of holding of this new share will include this. So it will be from here to here. Same thing will happen in case of demerger. So again, in case of demerger, you have received the new shares by giving away your old shares. The period for which the old company shares were held by you are to be included. So, same amalgamation, demerger. And in all these cases, you know that these are all cases which we already studied as not transfer, right? Then you have received equity shares. Why? Because the company did conversion of your preference shares into equity shares. We have seen this. So originally you had purchased preference. After 5 years, you gave back this and you received equity shares, right? So the period for which you are holding the old shares is included. So your equity shares, even though received today, the period will be counted from the date of preference shares. Same thing. You received electronic gold receipt by giving away your gold. That is, gold is converted to gold receipt. Again, the period of holding of gold, whatever period you had held gold, will be included in the period of holding of the receipt. So the period for which such gold was held by the assessee prior to conversion, this will be included. Vice versa. You receive back your gold by giving away the gold receipt. So now what is happening? Now conversion of receipt into gold is happening. Again, same thing. The period for which this receipt was held by you is to be included in the period of gold. So students, all these scenarios which I covered now, starting from point 2, 4 and all these, they are all scenarios which you have studied as not transfer cases. So what is our golden rule? Where any capital asset is acquired or received by you in one of the modes which is not regarded as transfer. So for you, your period of holding will not be from your date. Your period of holding will be counted from the date of previous owner. And why this is a golden rule? Because this one sentence covers so many points. Now we have already seen these points in the point of period of holding. We'll again see these points when we go to the topic of cost of acquisition. So students, I hope you have understood all these points. Today we complete the main part of capital gain chapter, that is when capital gain will arise when you have an asset and the asset is transferred. Right, students? I hope all these pointers are clear to you. So Arun, what is your question in this? You have said, sir, compulsory acquisition case. What is the question? What is special in compulsory acquisition, Arun? You had a purchase a property, a land. Today the land is taken over by the government. So what is special? From the date of purchase till the date of compulsory acquisition, that is the period of holding. What is special in that, Arun? Nothing special, na? Means I did not get why you are asking this specific point. There is nothing special in this. You had purchased land 10 years back. Today the government took away your land compulsorily. The law says this is period of this is transfer, and period of holding is also counted up to this date only. Nothing special, right? Understood, students? Clear to everyone? Perfect. Great. So let us conclude our today's session. Again, today we had a lengthy discussion, many points covered. Students, humble request, please revise, please read your module from page 1 till this page. That is the page where we come. Your not transfer list is running up to this page. So up to this page, you can even study amalgamation demerger because this is also relating to not transfer. That is, we will start from this 4.10 in the next class, which is the computation format which we have discussed. So up to this page, which is page number 401. So 3.401 is what you have to study up to this page. Fine, students? Clear with everyone? Everything understood, students, till date? Please, please, please study, revise so that things get consolidated. In case you have further query, questions, doubts, again, you can ask me. And the more you read yourself, in case doubts arise, you can get it cleared immediately. It will be through and it will get consolidated in your minds. Fine. Thank you, students. Thank you very much. Sanket ji, thank you. Good day. Yes, sir.